There's a very interesting debate going on about whether or not you should do financial models, revenue projections as a pre-seed company looking to raise money. So I thought I'd go through a few slides that we have on this from one of our valuation workshops, explain our rationale and the value that it can add to the process. So the first thing to acknowledge is that, yes, of course, pre-revenue companies particularly are notoriously uncertain, which makes projections seem risky on the surface or seem unreliable, certainly. But there is obviously still investment happening in these companies. Investors believe the pitch enough to invest. So how does that reflect on the value of projections? Well, the key there is to understand that what you're looking for as an investor, whether you know it or not, is coherence. You're looking to see that everything involved in the company, everything you talk to the founder about the operations of the company, the growth of the company, the risks of the company, they're all based on the same kind of underlying rationale and wisdom. That is the coherence you're looking for. It inspires confidence. It builds conviction. It's what tells you that there is a sound reasoning and competence behind the company. And this is what that looks like in practice. So you have ambition. Most of the time, founders will start with ambition, almost all the time. How they're going to make the world a better place. What is their goal? That is then converted into a strategy. How does that look like in terms of implementation, product strategy, go-to-market strategy? And often that is where the process stops, especially a pre-seed. What that misses is the important process of closing that loop and turning strategy into projections. And that's ultimately as complex as it needs to be. Take your strategy, consider what it looks like in terms of dollars rather than words, as a spreadsheet rather than a pitch deck. And then that adds a highly valuable third perspective that helps build the coherence to inspire the confidence and conviction. Because what it allows you to do is demonstrate that you understand what it takes to build a venture scale business. You understand what it takes to achieve the ambition that you set out. You understand the revenue targets you'll need to hit. You understand how growth will incur costs. That you have a competent understanding of the levers of growth that you have to pull in future. And yes, it involves building out a future that is uncertain. But actually what it does is it gives you a foundation that better prepares you for that uncertainty. If you need to pivot or make changes in future, you will have a base level instinct for what that change is likely to do to the kind of operations of the business or the economics of the business. Puts you in a much better position as a founder. Very quickly, this is a look at like a growth engine that may be the basis of a financial model. It's always helpful when you use kind of logic to build it as you go through a flow like this, essentially converting all the way from marketing spend through to profits. Have some underlying logic there that makes it a bit more robust and gives you a better understanding of how it actually works. Then as a spreadsheet, obviously typically 3 years or so for pre-revenue companies. And importantly, showing the key variables like cost per click or conversion rate, making those adjustable so investors can actually see what happens if your predictions aren't correct, because typically their assumptions will be way worse than the reality. If you let them try it themselves, they'll see it's normally not as bad as they may fear. You can also add a bit of confidence and context with benchmarking. So we have some data on average growth rates of the fastest growing companies, and importantly, looking at or understanding how the importance and the application of these projections differs based on stage. At early stage, it's not about accuracy, it's not about reliability, it's about showing your competence, showing you understand the model, showing you understand the outcome. And that is how you build confidence with smart investors.